Welcome to the Explainer. Let's just dive right in, shall we? Today, we're taking a completely blank screen and turning it into a fully functioning, highly adaptable financial model. And we're going to do the whole thing in just 15 minutes. To make this super practical, we'll build it step by step using a mock e-commerce t-shirt business as our real-world example. We'll be forecasting revenue, mapping out expenses, and building an entire income statement right from scratch.
But first, quick question for you. Have you ever downloaded a template or maybe inherited a spreadsheet from a colleague, changed one single assumption, and then just watched in absolute horror as the entire document broke into a sea of error codes? Yeah, it's incredibly frustrating. Well, today I'm promising you a dynamic, totally foolproof solution that stops exactly that from ever happening again.
So here's our blueprint for today. 1. Setting up assumptions. 2. Fixed versus variable expenses. 3. Building the income statement. 4. Handling taxes and errors. 5. Creating dynamic scenarios. And finally, 6. Bulletproofing the whole thing with data validation.
Section 1. Setting up your assumptions. This is where we lay the foundation. Okay, so the absolute golden rule of Excel modeling conventions is color coding. If you look at any professional model, you're going to see a very specific system. Blue text, that represents hard-coded inputs. Basically, these are the raw numbers you physically type in manually, like, say, starting with 3,000 t-shirt orders. Black text, on the flip side, represents dynamic numbers that are driven by formulas or linked to other cells. Sticking to this one simple rule makes sure that you, or anyone else playing with your model, never accidentally overwrites your crucial logic. The real trick is how we actually forecast our growth using those assumptions. For our t-shirt store, we're starting with a base of 3,000 orders. To forecast our 5-year revenue growth, we literally just take the previous year's orders and multiply them by 1 plus our projected growth rate. Let's say, just as an example, we predict 100% growth in year 1, and then we scale that down to maybe 35% by year 5. Once you lock in that very first formula, you can just use the keyboard shortcut Ctrl-R to drag it dynamically across all 5 years. It's a huge time saver.
Moving on to Section 2, Fixed versus Variable Expenses. Time to map out the costs.
Now, variable expenses scale directly with your business. Think about it. Every single time someone buys a t-shirt, it costs us $6.50 to manufacture it, plus the cost of actually fulfilling and shipping that order. Fixed expenses, though, those stay totally static regardless of how many shirts you're selling. We're talking warehouse rent, your base marketing budget, salaries. Keep in mind, though, as your variable orders scale up massively, you might actually hit economies of scale. That means your bulk ordering could drive down your per-unit manufacturing costs over time.
Section 3. Building the income statement. This is where we bring it all together.
Let's take a super quick tour of a formula's anatomy. To calculate our total manufacturing cost, we multiply our total orders by that $6.50 per shirt cost. Easy, right? But wait, if you just copy that formula straight down your spreadsheet, it's going to break. You absolutely have to hit the F4 key on your keyboard to lock the specific row reference for those orders. When you do that, you'll see a little $ pop up in your formula. That is your anchor. It keeps your math completely perfect as you drag those formulas down.
Once all those costs are mapped out, we can easily find our gross profit. This is simply our total revenue minus our total cost of goods sold. And here's a massive pro tip for you. When you need to quickly sum up your total costs, just use the shortcut Alt plus equals on your keyboard. It instantly auto-sums the entire column right above it. It'll save you so much precious time when you're calculating operating profit margins.
Section 4. Handling taxes and errors. Let's bulletproof this logic. Look, we all know the government is inevitably going to take their cut, right? So let's assume a 20% corporate tax rate, but here's the catch. If your brand new e-commerce business is actually losing money in year 1, you definitely shouldn't be paying income taxes on that. So to handle this, we use an IF statement. This bit of logic simply tells Excel, hey, if our profit is less than 0, just return the text NA. But if it's greater than 0, go ahead and multiply that profit by 20%.
But, of course, that introduces a brand new problem. To find our final net profit, we have to subtract our tax from our operating profit. If year 1 happens to show an NA for taxes, Excel is going to try to subtract text from a number, and that causes a really ugly hashtag value error. To bulletproof this, we just wrap our profit calculation in an IFERROR formula. This literally just says, if subtracting the tax causes an error, ignore it and default back to showing the original operating profit, or, in year 1's case, the operating loss.
Section 5. Creating dynamic scenarios. Time to make this spreadsheet smart.
We're actually going to build 3 totally distinct scenarios. First up, the live case.
This is the data that is actively driving our main income statement. Then, we copy our original assumptions over to create an uppercase or highly optimistic scenario. Finally, we create a lowercase, which is our pessimistic scenario. Because let's face it, things don't always go perfectly. For the pessimistic view, we'll assume maybe we only get 2,000 initial orders, our manufacturing costs jump up to $8 a shirt, and maybe the government hikes the tax rate to 25%.
Now, how do we seamlessly toggle between these optimistic and pessimistic realities without having to rewrite our entire model? We're going to use a seriously brilliant tool, the choose function. Think of this as the engine of our dynamic model. It literally does exactly what it says. It chooses a specific value from a list you provide based entirely on a simple index number.
Here is exactly how the syntax plays out. You set up a single cell at the top of your model, let's call it the scenario cell. In your live case data table, you type equals choose. Point it at your scenario cell, then point it at the uppercase data, and then finally the lowercase data. That's it. Now, if you type a 1 into your scenario cell, the model instantly pulls all your optimistic data. Type a 2 and bam, your entire income statement dynamically updates to reflect the pessimistic reality. I'm telling you, it is incredibly satisfying to use.
Section 6, bulletproofing with data validation. Let's prevent human error.
Okay, so because we only built 2 scenarios, 1 and 2, what happens if a well-meaning colleague comes along and accidentally types a 3 into your scenario toggle cell? Well, the choose function is going to look for a third option that just doesn't exist, and it will completely nuke your spreadsheet with errors. Boom, broken. So to prevent this nightmare, we use data validation. You just click on your scenario cell, head up to the Data tab, and select Data Validation. Change the allowed criteria to list, and simply type 1, 2. Doing this creates a sleek little drop-down menu right on your cell, but more importantly, it physically restricts the cell so no one can ever type a 3 or an A, or literally anything else that would break all your hard work.
Now, stepping back for a second, why does all this structural work actually matter? Because it allows you to instantly see the future of your business under totally different conditions. Just by toggling from scenario 1 to scenario 2, we can see that a slight dip in average order volume paired with slightly higher manufacturing costs actually delays our t-shirt business's profitability by 2 whole years. It shifts us from hitting profit in 2024 all the way out to 2026. For a founder, that is a massive game-changing insight.
Which brings us to our final thought. Through the magic of locked cells, IF statements, the choose function, and data validation, your mathematical model is now completely dynamic and totally error-free. The spreadsheet works perfectly. But remember, Excel is only ever going to calculate exactly what you tell it to. So the ultimate question you have to walk away with today is this: are the business assumptions you're typing into those blue, hard-coded cells actually grounded in reality? You see, the math is solved, but the business intuition, well, that's entirely up to you. Thanks so much for joining me on The Explainer, and keep building.